David, I'm glad to see that you're online. Um, David sent me some emails over the week, and I responded to each one, but I am not sure, David, if you saw my responses to your questions, because I asked for more specifics, and I never saw the specifics. So going back, staying with bull puts for a moment, David emailed me earlier this week, and he said that he was in a bull put credit spread, and the bull put moved up, and he was making a profit on both the short, which makes sense. We sold it at a premium, then we're able to buy it back cheaply, so we can profit on that. And then he said his long option also increased as well. And he wanted to know sort of how often does that happen, and how can I find positions when that happens. He said when the bull put spread rises, is that when it makes money, and how can it rise? Okay, well, this part of the question is a little bit different. So when you enter a bull put, you're static. Okay, let's just take a look here. When I open a bull put credit spread, I'm static. Meaning that in this position here, I just opened URI. Oh, let's go back. This is the 127, 125 for November 8th. 8th November, 127, 125. Okay, and I want to see something that has on this page that isn't there. A lot of good movement today, wasn't there? Well, we know Tesla moved, but still a lot of good movement up and down. This Sherwin-Williams position moved $1 today, but that's really, wow, it's really small compared to a $552 stock. So SHW, I'm writing this one down too, $552.50 to $550. Okay, and those are the only two I need. I'm sorry, I'm just looking at this number here and getting a little depressed again. Those of you who know me know that several years ago, back in 2009, 2010, I did a 6-month position on Domino's Pizza, and I was really happy with a double-digit return. It was actually less than 6 months. I think it was 3.5 months double-digit return because I rode the stock from $13 to $18. Yeah, $13 to $18. It's now at $271.66. So, yeah, we all know a lot of stocks like that. That one just always gets me a little upset when I see it. In any case, here's what I want to show you. Why am I looking at these two positions, David? What I want to do is actually go back a day for both of these stocks, URI and Sherwin-Williams, SHW. And the reason why I want to do that, I'm just going to go to the option chain for SHW. And I'm going to go back just one day to October 24th. And let me just check something real quick here. Oh, let me go back to the search. I'm sorry. Yeah. Okay. So October 8th, I'm sorry, October 24th, yesterday, the November 8th expiration. For Sherwin-Williams, it was trading at 574. Wow, it was up 10 points the day before, too. That's interesting. Let's go back another day. Good, perfect. At 563 on Wednesday, October 23rd. I want puts only, sorry. So for the November 8th expiration, there we go, the 552.50 was bid of 480, ask of 560, so let's just call it 520 midpoint. So I could have sold to open the 552 at 520 and bought to open the 550. There it is. I'm sorry, 440 to 490, so at 465. Okay, so we've gotten about 55-cent net credit on this position. Pretty good return. Okay, so keep that in mind. 552.50, 550, net credit of around 55 cents. Okay, jot this. We'll look at that in a second. So now let's go to next. Next day, pops up 10 points. What would we expect to happen? Well, this should lower in price drastically, but this should too. That was my confusion, David. I'm sorry, when you said you saw a stock rise and you're profiting on both the short and the long. Both of them should have lost value unless there was a drastic increase in implied volatility the same time the stock rose. Remember, this was the day of the 10-point movement. So in this case, we got in for 55 cents. Both puts lowered in value. Our 552.50 now dropped to 250 to 295. 45 cents, let's call it 25 cents. So if we went to sell to close it, we might get about 270. If we went to buy to close it, we'd probably pay about 280. I'm going to say 280, okay? But remember, we collected 520. So I'm getting a $2.40 profit on that position. But the 550 cost me $465. If I sold to close it now, if we do take the midpoint, it'd be at $245, right? So what would have happened there? I would have lost $2.25 on the long, okay? But as a liquidation value, we collected 55 cents up front, and if I close this for 240 and this one here at 225, I'd still have a 15-cent profit. My max profit was 55 cents, but I could liquidate here for 15 cents. It'll never be higher than the liquidation will never be higher. It should never be higher than the 55 cents you've got on the original net credit. Okay, now let's go forward to today. We had another rise in price. It's still going up. It's up end of today. It didn't move that much today, 574.93. And am I still on November 8th? Yes, I am. 552.50. I'm just jotting this down. 205 to 275. So let's call that 240. It would buy to close 552 at 240 at midpoint. 175 to 215 would have cost me 195. I would have only gotten 195 back. Sorry, to sell to close the 550. Okay, what's the difference there? That's only 45 cents, isn't it? So what does that mean? I collected 55 in. It would cost me 45 cents to liquidate. I'm only making 10 cents on the position. So it's interesting. Yesterday with a 10-point, well, it makes sense actually. Yesterday with a 10-point move, it got up so drastically that at one point at the close, we could have closed it, made 15 cents out of our expected 55. But at the same time, today, I could only make 10 cents on the position out of 55. Not even close to halfway yet. Now, of course, we were going to talk about URI, which moved us 6 points today, but let's just do that real quick as well. So remember, our URI position we were looking at was that 127, 125 for November 8th expiration as well. And if I go back 2 days, I'm sorry, let's just go back 2 days, the 24th and then to the 23rd. November 8th weekly, we'll call it $1 at midpoint for the 138 for the 127 and $1 for that. So the URI 127, 125 spread would have resulted in a 38-cent net credit. Going forward to the next day, we were down $1.67. It dropped to 132. Midpoint here of 162. So what happens? This moved up 62 cents, but that's a negative to us. We sold this option for $1. I'm sorry, $1.38 or so. Buying it back now would cost us 162. But we could get 118 selling to close the 125. But again, we took in 38 cents of net credit. This liquidation value would be a loss of 44 cents or 44 cents. I was right the first time. I'm sorry, 44 cents. So this is still at a loss of 6 cents. That makes sense. Stock dropped 167. Let's go to current. Let's go to today. 78 cents on the 127. So you're making profit there, but the 125 is down to 55 cents. Liquidation value here, even though the stock's up another 338, but if you liquidate a position, buy to close at 78, sell to close at 55, you're paying 23 cents. So again, you took in 38 cents, so here you're at a 15-cent profit. You're at a profit, but not quite half of what you expected to make when you first opened the position. The only time, I can't even think of how this would work. It's very difficult. The way that the options are priced and the way that the spreads work is that in order for this long option you mentioned to increase in value on a bull put credit spread, it means the stock has to fall which means this option, the one that you sold, which is closer to at the money, is probably increasing in price faster due to the at the money bell curve value. So you're probably going to be losing more here than you're gaining here when the stock falls. When the stock spikes up, both are probably losing value, but remember, your long option, which is further out of the money, has less value to lose. So it's going to be losing value slower. Your higher strike option, which is closer to the current stock price originally, should be losing value a little bit more slowly. You'll still be able to maybe close for a profit on the entire spread, but you should be losing on both options. I can't explain a scenario that you mentioned, David, where you had emailed in. That's why I asked for the specifics, so I could see if there was any shift that day in implied volatility that I didn't see, or anything along those lines. But in general, what shouldn't really exist, because if the implied volatility is changing on one option, it's changing on the other, up or down. So in this scenario, if this option starts to lose value, which is a gain in your favor, this should start to lose value too. If this option starts to gain monetary value because the stock's falling or an increase in implied volatility, which is against you, this one should be gaining. The one that you bought should be gaining as well, which is in your favor. And that's why I sent you the reply back as soon as I saw your email and asked you for the specifics of the strikes, the prices, expiration, and what was the time of day and what was the stock price when you did it, so I could see was there any change in the stock price or fluctuation up and down during that daily time period, or was there any noticeable shift in implied volatility or delta that was opposite of what I'd think. In other words, if the long option implied volatility shot up but the short option implied volatility dropped, you shouldn't see that because they're on the same stock, same expiration cycle, and they're only a few strikes apart. So that's why I needed the specifics of what was happening, because what you described, you may be able to close the position early for a profit, liquidate your spread early with the movement in your direction, but I can't see a scenario in my head of where the long option would have gained in your favor and the short option would have lost money in your favor. So it's just a strange thing, but that's okay. I mean, it's just if that did happen, I could probably see a way to explain it based on the numbers of the day, what happened to implied volatility, what happened to delta, what happened to the stock. It's just very hard to see in that case how that would happen, because in general, yeah, if the stock moves up and you're in a bull put, you should be able to liquidate for a profit, but you shouldn't see one option going down in price while the other is rising in price. If you're looking at your portfolio and your broker, now that's a different scenario, in the sense that if your short option fell by 20 cents, which is possible if the stock moved up, but your long option only lost 10 cents, that's why you can close it for that 10 or 15 cent profit early, because one changed value a little bit faster, the other, the higher change value faster. But your brokerage or your portfolio view might be showing it as one is a gain in your favor and one is a loss, because they're showing it directly as, hey, this one is favorable for you because the premium's declining. This one you paid for, though, is declining as well, just not as much because you bought it and it's dropping in price too. It's just less of a decline than what you saw. And of course, if there's any kind of errant entry at the end of day where the bid-ask spread for the long option got really wide and you're looking at a midpoint, but it's not a realistic midpoint because the spread got too inflated, that could be an issue too. Okay? And David's question is not really a follow-up question to this. It's more of a thought here. It's not a thought. But David's follow-up question is, how effective is the weekly spread trades for 1 or 2 days? I don't know. Okay? I'm just going to be dead forward honest with you. The past couple of weeks, we've answered questions for investors, and we posted the archives because I always say that I'm going to answer any question that comes in, and I'm going to post the archives as well. And, oh, I'm sorry, that didn't do what I wanted it to. Hold on, ladies and gentlemen, my apologies. Okay, so we answered questions 2 weeks ago about sort of one-day spreads on SPY, what to look for, how reasonable are they. Last week, we answered questions on intraday trading on SPY, but I think that was for straddles and strangles. And then we did the 6-month straddles. Oh, the intraday one was what positions might work intraday on SPY if this and that. Okay, if you had some expectations. They're not bad questions, don't get me wrong. They're just questions I don't have real answers for because we here at Power Options don't advocate day trading options, number one, and we haven't traded it ourselves or tested it. So we're not, I'm just going to put a little Ghostbusters sign here, a little Ghostbusters cross there. I don't have a lot of data to support, wow, can't write today, day trading. I don't have a lot of data to support how successful one-day spreads, two-day spreads, and so forth are. Now, a comment came in during the discussion in the past couple of weeks. So SPY offers a Monday, Wednesday, and so does SPX, but Monday, Wednesday, and Friday expiration. So on Monday, I could trade the options that expire that day. On Tuesday, I could trade the Wednesday series. If I closed them, then Wednesday, I could trade the Wednesday series. On Thursday, I could trade the Friday, and then on Friday, I could trade the Friday for a one-day trade. Most stocks don't have that. Only about 475 of the 4,400, 4,500 optionable stocks, indexes, and ETFs offer weekly options. And a lot of those are 2 times, 3 times an inverse ETFs, a fair amount. I know this off the top of my head because I was working with a customer the past week and a half to set up a specific type of weekly bull called debit spread search. And their stocks, non-index and ETF, standard stocks between $30 and $300 that offer weekly options, the total number of securities is 305. Okay, so why am I bringing that up? Well, the idea here, David, is that a lot of times investors will look at a one-day out spread. Okay, and they'll say, let's just take a look. We'll go to Smart History. I'll go to yesterday, the 24th, and I'm going to run the weekly bull put, but we're going to change it to just the one-day spread. That we're going to change criteria on the fly once the history comes up. But a lot of investors will say, and I've kind of illustrated this pretty well also. I've got to sort of talk myself backwards from your previous question to answer this. But look, a lot of investors will look at it and say, look, you could trade a 5-day out spread, and you can only go a couple strikes out of the money to get an 80% or 75% probability, and you're making 12 cents on a 2-point spread if everything works out the way you want. And I say, okay, well, you can also trade a 2-week out spread where you can go 2 to maybe 4 strikes away with an 80 to 85% probability of expiring worthless, and you can collect maybe not double, but maybe 20 to 22 cents on a 2-point spread. All right, now I know I'm throwing numbers out there here. Oh, I did submit, I'm sorry. Forgot the extra click there. But why am I mentioning that? So on a weekly spread, I'm still taking the same 2 points of risk, but I'm only making 12 cents. I might not get double, I might only get 20 cents going out 2 weeks in time for 200. But what does that mean? That means that if I have one spread that hits the full loss here on my 5-day out trades, it's going to take out more profitable trades than this one here. This is still an 8-to-1 risk-reward ratio. This is closer to about 10-to-1, isn't it? Not quite, but it's a little, actually, I'm sorry, no, it's about like 12 to 14-to-1. So that's one thing. Now, when you talk about a daily spread, I mentioned there's only 305 standard securities that offer the weekly series that are between $30 and $300. There's more beyond $300 that, as I mentioned, 475 total if you include all the indexes and ETFs. It's a limited universe, but that's not the issue. We know, and we talked about this before, that based on the time value decay curve, that's a sloppy one, but we know that we want to be in this range for selling premium. It's always better. We'll get a better annualized return selling week by week by week than month by month by month, 3 month by 3 month by 3 month, or 6 month by 6 month by 6 month. Why? That's just the way the options are planned. The option that's 3 times the amount out in time is not going to be 3 times the cost. That's why we want to be buying further out in time for things like protection, speculation, 2 to 3 month out straddles on a broad-based index, and we want to be selling nearer term for the rapid decay. And also, when you look at it that way, if I'm selling weekly series, this was the big selling point of the weekly options when they first came out, of course, you're always going to have a higher annualized return selling week by week than you would have selling every 2 weeks, than you would have selling every 1 month or every 3 months. Okay? You're going to get a higher annualized return. So someone comes along and says, well, if I if I do one-day spread trades, I'm going to take this extremely high annualized return and quadruple it. No, you're not. That's a faulty view of the annualized return on one-day trades. Why? Remember what we just talked about with the positions we saw. So we'll go Monday, Tuesday, Wednesday, Thursday, Friday. When we were talking about URI, more specifically that Sherwin-Williams position, we entered into a credit on the position, a decent credit of 55 cents. But the very next day, the stock moved up 10 points, and it would cost us, 40 cents, I believe, to liquidate the position. So we would have made only 15 cents. Now, you made a profit, okay? So we would open it Wednesday. Here was that 15-cent profit. Here was that. Now, you're right. This was a 2-week out trade. But if I had sold the Friday series here on Wednesday, I probably would have only gotten 15 cents. And even with that 10-point move, it didn't go to zero. This might only be a profit of 5 cents. And then on Friday, it became a profit of 10 cents, and then it expired worthless. Had I opened that position on Thursday for expiring Friday, that might have only been 10 cents, and it wouldn't have been zero. It would have expired worthless, but that's 1 day of 10 cents. Now, the annualized return doesn't say, hey, you're only doing this every 4 days for 1 day. It says if you do this profit 10 cents off, let's say, a 2-point risk or 2.5-point risk, if you do it every day for the next 365, you get an annualized return. Well, we already saw that if you bought a position Monday, if you sold a position Monday for 10 or 12 cents or 55 cents, it's not going to be zero on Tuesday. You're not getting that maximum return until Friday if it all expires. Okay? So that's the one thing. Great comment that I'm probably sure he already repeated further down, and there was a gentleman who also commented on the YouTube video that we put in, that we posted when we were making this discussion on 1 or 2 day out spread positions in that case, is the fact that trading 1 day spreads is extraordinarily risky. Okay? And because the risk reward is not worth it. Opening a trade on Thursday for only 5 or 10 cents. I forgot the gentleman's name who posted the comment on YouTube. It's there. It's public. I'm not going to hide any comments that are negative or positive to what's said to my commentary or my discussion. I post every comment that comes in. Don't hide any of them, and I answer them as well. But his argument, I agree with. Placing a trade on Thursday for Friday, even if you have a good probability of 70, 75, 80, 85%, you're probably only taking 5 or 6 cents for risking 2, 2.5, maybe even 5 points. So in the unexpected event, like we've seen on some Fridays, a couple weeks ago, there was a huge downturn in the middle of the day because of some news that came out. Well, if I took the full 250 loss, if I had a 250 spread and I only took in 5 cents of net credit on that position, if this went below both strikes in 1 day and I took the maximum loss, how many trades is that wiping out? This isn't 50 cents. This isn't 5 to 1. This is 50 to 1. You're wiping out 50 previous gains from a sudden uncontrollable event with 1 loss. And if you had 5 spreads open, they might all go to that same loss, depending if you were bullish or bearish, David. You see what I'm saying? So again, not something I've tested. But when you look at the structure, you look at the risk reward, it's very concerning. And ignore the annualized return when you're doing this because you're not doing this every day. Because even if you open a position on Monday, it has to expire on Friday, right? It has to be for Friday expiration. So what does that mean? In the first day, even if the stock moves up, you're only seeing a small profit. You're not near the full profit yet. So you can't base it on an annualized return because you're not going to be getting that return every day. Sam says he usually goes a month or 2 away. There's a question that came in that I think is related to this directly, but I wanted to show you, I apologize, I wanted to finish this up here, David, on the search. So that's my comments on the day trades. I'll answer any question that comes in about what would I expect for doing a one-day spread trade on anything, SPY or on the market in general. I can't comment on their success rate. I just don't like the risk reward. It's too short of a term for me. Okay, so I'm going to clear the filters here and just run a basic search, 0 to 2. Minimum net credit of, I'm going to say 7 cents. We're going to go bold, but I'm still going to look for an 80% probability. I'm just going to keep one of my other settings here, greater than or equal to 250. It's okay. And I'm going to avoid earnings between now and expiration. All right, so I'm just creating a simple search for the 24th of October. Any bull put spreads that didn't have earnings, 80% probability, strike difference greater than 250. That's just personal preference, but I'm just so it goes along with some of the other ones we're seeing. Now this might be a lot of results, but what I'm going to try to show you is what is the net credit we would have expected the day before. Yeah, let me do that too. What you're seeing there, were a bunch of, I'm going to remove indexes and ETFs. There might have been a good index trade, but oh, I didn't put that list here, did I? Thought I did. Okay, I'm sorry. I didn't add the indexes and ETFs into this account. I'm going to try to remove indexes and ETFs. Maybe I'll just do that one, ETFs to remove real quick. Let's just see if we get that out of there. In any case, one more subtle thing I want to do here. Yeah, one more subtle thing I want to do here, because sometimes I'm going to keep this under 40. I'm going to limit the bid-ask spread. All right, so anyway. I should put open interest into. It's okay. We'll see what we get here. That's better. Okay, so some of these don't look too bad. Here's a 43-cent net credit on MA. That's pretty good. Here's a 40-cent net credit on SHOP. These are very high-priced stocks, though. So yeah, we're in Google at 1,200. SPX here at 3,000. Sure, 58 cents on a 10-point spread. It looks like a 5-point spread. We've got some good returns in here for a one-day trade. Don't get me wrong. And we've got some good probability. But what do you also know about a one-day trade? The one-day trade with an 80% probability, that means that based on the past trading range on the stock, that for, last 50 days, it's not likely it'll move more than 1 or 1.5 points in the next couple of days. Now, over a 40-day time period, it looks at it a little bit differently. So I'm just going to run the group results. I'm going to see what happens. And this is just one example. We know the market was generally up today. As Sam mentioned, we had some good movements with the earnings and so forth. Tesla, his example again. Okay. All right. So let's see here. So let me just, while this is waiting, let me go back. I'm just going to minimize that for a second. Let's go back here. But these are good credits and good returns for a one-day trade. But as I mentioned, see here, the first one's 85% probability. You're only $3.75 out of the money. Whereas if I did MasterCard 2 weeks out with an 85% probability, I'm probably 10 to 12 points below the current stock price, not $3. Okay, because that's just the way the probability works. So you're still pretty close here as well in this scenario. Okay, let's see here. Randall, your question's next, and then Guy, I'm sorry, Guy's question I believe is next after this, real quick, and then we'll get to Fernando and there as well. Okay. All right, so just wanted to scroll through the questions real quick, or the comments. So Sam was talking about always cover your in-the-money options before expiration. That's another idea. Remember we were talking about the credit spreads and the short obligation. Well, Sam's saying if you know you're going into expiration at slightly in the money, I prefer to close it. Sam says you could cover it. You could buy another put, or you could short shares of stock ahead of time to do that, but that would require already having the capital. Or in a bear call, buying the stock to cover the short call that might be in the money, but that would already require the capital, okay? All right, and Sam was talking about PHM as a potential stock. All right. Okay, just going through some of those notes there. Okay, so I'm sorry, in order, yeah, Guy next, then Randall, then Fernando. Okay. All right. Okay, so let me just check this again real quick. It's still, oh, there we go. Yeah, so in this case, all of them would have returned for a full profit from the 24th to today with that basic search I did sorting by return. I can't say that's going to happen every time. I can't say that you're always going to get these net credits because, again, it depends that I based it on probability, but you see how close we were. That's taking a chance. Now, this one's pretty good. This one's only 4 points out. That's still okay. This one's 8 points out. That's good. And, as you go lower, there's only 3 points out. And there's a lot of repeats in there. I wouldn't have traded 2 trades on MasterCard and 2 trades on Tesla. I just would have picked one of the other. But in this case, it worked. But remember, you're not doing this every day. You're only doing this Thursday to Friday, if it works, if you pick the right day. The discussion last week was from someone who felt they had a good analysis of what SPY was going to do based on the opening range and what positions could they use to take advantage of what they felt was the high and the low that it would hit that day. But again, I don't advocate the day trading of the spreads. I don't know how successful they can be. I know that every time you take a loss from an unexpected event, it's going to wipe out more previous trades than you originally expected using a longer term position in that case as well. So that would be a tough one to go through.